Hey guys, I'm the Newb investor. It came to my knowledge that this stock had fallen 60%, so I decided to take a look at their financials to see whether the stock is indeed trading at discounted values. The stock is Foot Locker. It currently trades at 30.98 with highest price of 79.20 on December 2016. That's 60.88% from the highs. Market cap of just 3.11 billion with PE ratio of 3.6. EPS trailing 12 months of 8.6. It gives out an annual dividend of $1.6 per share, a yield of 5.16% of the current price. Checking their payout ratio, it is safe at 19%. Let's screen it with my three metrics. First metric, we want an EPS lower than 3. It's 0.42. We get this by dividing the PE by the EPS. This tells us that they do a good job at increasing their earnings while buying back shares. I've added here the EPS from 2017 to present, increasing, which is good, and the OSN here is outstanding shares, which is decreasing, also good. Next metric, we want to pay $1 or less for 1% of the money they're making. The above values are in billions, while below is in percentages of their respective revenues. We do this so we know how much of the revenue goes to expenses and how much they keep to themselves. I'll show you the relationship of the sales here. We'll use 2020's data because honestly, this one here, the FCF, is data from trailing 12 months because I can't seem to find the FCF for the current year just yet. In 2020, they used $5.365 billion to make a revenue of 7.548 billion. That's 71.08% of the revenues. In average, they use around 90% in costs to make their revenues. But what we'll use here is the current year's yields and the 5 and 10 years averages of their yields. The more data, the better. But in this video, we'll only be using 5 years of data just to show you our process. Of the 4 highlighted values, we take the lowest to divide the current PE. Why the lowest? We want to take the lowest yield so we can have a baseline of our assumptions. In this case, it's 6.17, the 5-year net income yield average. We'd use it to divide the current PE and we'd get a discount of 0.58. Meaning we're buying this now at a discount as we're buying their yield at only 0.58 instead of 1. If you see here the revenue growth, I don't think we should pay premium for this stock because I see no consistency in their revenue growth. Next metric is historical PE. I have here 2 historical data, one from Guru Focus, where the data is readily available, and the other from Macro Trends, where I manually pick the PE where the stock has traded in range of consolidation. You'd see here the highs and lows of PE where it's traded, but we'll only use the lowest of the 2 average PEs here to divide our current PE of 3.6. Why the lowest PE again? Same reason, we want to make the lowest PE our base of our assumption. We have here the discount of 0.31, meaning compared before, it's trading at a low PE now. To conclude, this stock easily beats my metric. It is a screaming buy right now as it trades at a discount. Should you buy the stock now? No. You have to look at the risks associated with this stock and why it had fallen 60%. It's all green now, but it doesn't mean it can't go any lower. I think the fair value is around 85. That is when you multiply the current EPS of 8.6 by the lowest yield in metric 2, which is 6.17. Based from historical PE, the price can go up to 80s. That's an easy 60% upside. This 3 metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price you pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.